Hi, my name is Jamie Tony Gagne, and I'm here to talk to you about this year's RBC Challenge. So, the focus this year is mortgages. So, something that the banks tend to look at when trying to decide if they're going to give you any sort of credit, whether that be a mortgage or to take out a car, are the 5 C's of credit, which include character, capital, capacity, credit history, and collateral. So character is important because it shows how well you are able to manage your finances. The criteria they look at for character includes employment stability, your type of employment, so whether that's seasonal, salaried, or full-time, investment and saving strategies that you may input in your life, and your relationship with RBC. So capital is really important because it speaks to how much you own versus how much you owe. So the criteria they look at for that is your net worth positive or negative? What assets do you have? So capacity speaks to how much you can afford to pay. So for this, they look at total debt servicing ratio. So income coming in versus debt being paid out. So credit history speaks to how you have dealt with your credit in the past. For that, they look at your payment history, your previous use of credit card facilities, your number of credit bureau reports in the last 12 months, as well as the minimum credit score of 650 for a mortgage out of the 0 to 900 range. Collateral speaks to if there are any assets being offered to support the credit application. In this case, that is your house that you're applying for the mortgage on. Just as if it was with taking out a car, your car would be your collateral. As well as the minimum 650 credit score and the criteria listed above, they're also going to look that you have 2 credit products in good standing for at least 2 years. So for down payments, when you're looking at the lowest of the low, you're looking at a default insured mortgage. The range is greater than 5%, but less than 20%. So for 5% of $139,000 house, you're looking at $7,315. However, as mentioned in the name, you will need to pay mortgage default insurance with this, and that fee is 4% tacked on to your mortgage. So you're saving less over time. That is in place in case you can't keep up with your payments and the bank needs to sell your house and they don't sell it in a certain time frame. Then the insurer who you're paying that 4% to will take that over. With a conventional mortgage, you are looking at a minimum of 20% of the purchase price, so a bit higher, and that's what we would have been looking at maybe like 50 years ago, being what we know best, hence the word conventional. So you will not need to pay mortgage default insurance with this. So that is the bright side of the 20%. So when we look at taking out mortgages on reserve, you have to go through your band office and their individual housing policies for mortgages. So with RBC, there is the On Reserve Housing Loan Program. It is a national RBC program to help facilitate ownership to status and non-status members living on reserve. There is also the Ministerial Loan Guarantee Program, where the band is given a lump sum of money to be divided out based on their own criteria, whether that be to create rental housing on reserve or to assist individuals in making their own properties. Then I decided that I would use the RBC mortgage calculator for a home that I found listed on Kijiji at $139,000 in the Sydney area, so it was off reserve. So it was listed at $139,000. The monthly mortgage payment with a 5% down payment would be $646.87 with the default insurance included. So the total interest cost for 25 years is $49,496.97. So using the affordability calculator, kind of in reverse, I managed to find that I must make a minimum of $39,150 a year to afford this home between my partner and I. So looking at that, you might ask, how did I get that number? So with the 5% payment of like $7,315, as well as looking at an expense of, if my partner and I each had a credit card with a $500 spending capacity on it, so with like a $30 a month payment, uh, and looking at trying to aim for a $647 monthly payment, then this is how much we would need to make monthly. That's for a 25-year mortgage with a 2.49% interest rate, with the default insurance included, of course. Thank you for your time. Lalio.